Did you know that the United States added over 1,000 new millionaires every single day in 2024, bringing the total to roughly 24 million Americans with investable assets crossing that seven-figure mark? Yet, ask almost any of them what the moment actually felt like, and you'll get the same surprising answer. It was nothing like they expected, not even close. So if $1 million is supposed to be the number, the one we've been chasing since we first heard about compound interest in a personal finance book or a YouTube rabbit hole, why does hitting it feel so ordinary? That's the question we're going to answer today. And I'll warn you right now, the answer is going to challenge some things you probably believe about money, ambition, and what financial freedom really looks like. Stick around, because the last point we cover might just be the most important shift of all, and it has nothing to do with your portfolio balance. Let's break it down from the very beginning. The morning after $1 million. Here's the first thing that happens when your portfolio balance crosses seven figures. Absolutely nothing changes about your morning. You still wake up at the same time, you still brew the same coffee, the neighbor's dog still barks at 7 a.m. Life in every visible and tangible way looks exactly the same as the day before. And that throws people off more than anything else. The reason it feels so anticlimactic is actually simple once you understand it. That $1 million isn't sitting in a checking account waiting for you to go buy a sports car or book a villa in Italy. It's invested. It's in index funds, retirement accounts, brokerage portfolios. It's working, not sitting. And in high-cost cities like San Francisco, New York, or Boston, $1 million investment portfolio might not even make you the wealthiest person on your block. The milestone that felt enormous from a distance starts to feel surprisingly average once you're standing on it. What if I told you that this feeling, this quiet, almost deflating sense of normalcy, is actually one of the most psychologically disorienting parts of the whole journey? Because for years, maybe even decades, you've been running toward a finish line, and when you cross it, there's no tape, no crowd, no announcer, just Tuesday. Researchers have a term for this, the hedonic treadmill. The idea that we adapt almost immediately to new circumstances, good or bad, and return to our emotional baseline. Hitting $1 million is no exception. The high you expected either never arrives or it lasts about as long as a notification ping on your phone, and then you're back to normal. But here's the thing most people miss completely. That normalcy is actually hiding something really powerful happening underneath the surface. And that's where things get genuinely interesting. Your brain starts playing a different game. Once the dust settles and you realize the confetti isn't coming, something subtle but significant shifts in the way you think. And this happens to almost everyone, whether they expect it or not. $1 million stops feeling like a destination. It starts feeling like a launch pad. Instead of thinking, I finally made it, your brain almost immediately recalibrates and says, okay, what's next? Suddenly, $2 million doesn't seem that far. $5 million starts showing up in your mental math. This isn't greed, and it's really important to separate those two things. What's actually happening is that your financial ceiling has been lifted. You've proven to yourself that big numbers are achievable, so your brain naturally starts looking further down the road. Now, remember, this shift in perspective has real consequences for how you behave with money. People who once celebrated a 15% annual return start wondering if they could be doing more. They start paying closer attention to people who operate at higher wealth levels, the investor who has real estate cash flowing on the side, the entrepreneur with a business stake that quietly grows every year. These choices, which used to feel abstract or out of reach, suddenly make total sense. The goal you spent years chasing is now in the rearview mirror, and your windshield has gotten a lot bigger. But, and this is a genuinely important but, don't let the momentum trick you into skipping past what you've actually accomplished. A lot of people blow right past $1 million without pausing to recognize how rare and meaningful it really is. Globally, crossing 7 figures puts you in an extraordinarily small club. That's worth sitting with for a moment before you start sprinting toward the next number. The compounding machine you've built. Now, here's where your money starts doing something that honestly feels a little surreal the first time you really understand it. At $1 million invested, you've essentially built a machine. And this machine doesn't clock in at 9 a.m. or take sick days or ask for a raise. It just runs quietly, continuously in the background. The S&P 500 has historically returned around 10% annually over the long term, including both the good years and the painful ones. That means, on average, a $1 million portfolio could grow by roughly $100,000 in a single year without you contributing a single extra dollar. Let that sink in for a second. $100,000 in 1 year, passively. That's more than the median household income in the United States, and you didn't earn it by working overtime or landing a promotion. The math did it for you. And when you factor in dividend reinvestment over the long haul, the S&P 500's average annual return has historically been closer to 11% or higher. At that rate, a $1 million portfolio could double in roughly 6 to 7 years through the power of compounding alone. So in theory, you could be looking at $2 million within a decade, $4 million after that, all without lifting a finger. Think of it this way. When you had $50,000 invested, a 10% return gave you $5,000. Nice, but not life-changing. At $1 million, that same 10% return is $100,000. Same percentage, completely different impact. The math doesn't change. What changes is the base it's working on. That's the snowball effect in its purest form. The bigger it gets, the faster it grows. It's the difference between rolling a golf ball down a small hill and rolling a boulder down a mountain. Same physics, completely different outcome. What $1 million could actually pay you. Once your money starts working, the natural next question is, what can it actually generate in terms of real usable income, not theoretical growth numbers, actual money you can live on? This is where the famous 4% withdrawal rule comes in. Financial advisor William Bengen developed this guideline back in 1994 after analyzing 50 years of stock and bond market data. His conclusion was straightforward. A retiree can safely withdraw 4% of their portfolio each year, adjusted for inflation annually, and have the money last through a 30-year retirement in virtually any market condition. It remains one of the most widely cited retirement income strategies in financial planning today. So what does that mean in dollars? At $1 million invested, the 4% rule gives you about $40,000 per year. Before you say that's not enough to live on, let's put it in context. If you're also collecting Social Security, which averages around $1,900 per month for most people according to the Social Security Administration, you're looking at a combined baseline income of roughly $62,000 to $63,000 annually. For most people in most parts of the country, that covers the essentials comfortably and still leaves room to breathe. And here's a detail that often gets overlooked. Depending on how your investments are structured, in Roth accounts, for example, a good chunk of those withdrawals could come out completely tax-free. With the right planning in place, your $40,000 withdrawal might actually cost you very little in taxes. That changes the math considerably. Now, this doesn't mean $1 million is a retirement guarantee for everyone. If you're living in a high cost of living city, supporting a family, or retiring early at 40, you'll need more. But it does mean that at this milestone, retirement stops being a distant dream and starts being an actual plannable reality. That psychological shift alone is enormous. When losses stop being just numbers. Here's something nobody talks about enough, and it's one of the most underrated changes that comes with hitting $1 million. Your relationship with market volatility completely transforms. Back when you had $50,000 invested, a 10% market drop meant a $5,000 paper loss. Uncomfortable, sure, but survivable. Easy to brush off, easy to hold through. At $1 million, that same 10% drop is $100,000 gone, at least on paper. And depending on your income, that might represent 1 year of savings, 2 years, maybe more. Suddenly, the market isn't an abstract fluctuating line chart. It's your money in real numbers that relate directly to things you understand. A 10% correction doesn't feel like a statistic anymore. It feels like a new car, a year of your kid's college tuition, or 3 years of mortgage payments evaporating overnight. This changes how you think about investment strategy in a very fundamental way. Where you once might have been chasing the highest possible returns, you start caring about consistency. A steady 7% that lets you sleep well at night starts looking a whole lot better than a volatile 12% that has you checking your phone every morning with dread. Preservation starts sharing the stage with growth. Balance, diversification, and allocation stop being boring terms your financial advisor throws around and start feeling genuinely important. The S&P 500 has had some brutal years, down 18% in 2022, for instance. For a $1 million portfolio, that's $180,000 in losses in a single year. Knowing that, most investors at this level start thinking much more carefully about how they're positioned, not to avoid all risk, but to take smart, intentional risk that aligns with where they actually are in life. The freedom nobody talks about. Here's what most people get wrong about hitting $1 million invested. They think it's about buying things. It's not, at least not in the way most people imagine. The real shift isn't about what you go out and purchase, it's about what you no longer have to do. What if I told you that the most valuable thing money can buy at this level isn't a luxury car or a vacation home? It's options. Pure, simple, life-altering options. Think about it this way. Before reaching this point, almost every major life decision has a financial leash attached to it. Should you leave a job that's draining you? Well, you can't afford to. Should you take a year off to figure out what you actually want to do with your life? Not really an option. Should you say no to a client who treats you poorly? Better not. Every choice carries the weight of financial pressure behind it, and that pressure shapes how you live more than most people ever consciously admit. At $1 million invested, that leash gets a lot longer. Maybe not cut entirely, but significantly longer. Suddenly, you can look at a miserable job and think, I don't have to stay here forever. You can explore a passion project without the panic of wondering how you'll pay rent. You can work part-time, switch careers, take a lower-paying role that actually energizes you in the morning. The corporate manager who's been grinding in high-stress environments for 15 years? They could walk into a part-time bookstore job, less pay, predictable hours, actually enjoyable work, and the portfolio quietly keeps growing in the background. And here's the beautiful nuance that really gets people when they hear it for the first time. A lot of people who reach this milestone never actually make the dramatic change. They don't quit the job or move to a beach town. But knowing they could, that awareness alone changes everything. It changes how they show up to work. It changes how they respond to a difficult boss. It changes how calm they feel during uncertainty. The option itself, even when unused, has enormous psychological value. That's the kind of freedom money can buy that you won't see on an Instagram post. It's quiet, it's internal, and it's completely real. Lifestyle creep, the silent enemy. Now, here's where I need to slow down and talk about something that doesn't get nearly enough attention, because it's the thing that can quietly undo everything you've built. And it happens so gradually that most people don't even notice until it's already done. It's called lifestyle creep, and it's one of the most common traps people fall into right after hitting a major financial milestone. What is it? Simple. As your net worth grows, your spending grows with it. At first, the increases seem completely reasonable. You've worked hard, you deserve to upgrade a few things. You stop clipping coupons. You start ordering the better wine at dinner. You book business class instead of economy. Each individual decision feels justified, and honestly, most of them are. But together, spread across 5 years, they can silently inflate your monthly expenses by thousands of dollars. Here's a number that should stop you cold. Research has found that a surprisingly large percentage of high earners, people making $300,000 or more, report feeling financially stretched month to month. Not because they're bad with money, but because their lifestyle expanded to meet and sometimes exceed their income. If that can happen to someone earning $300,000 a year, it can absolutely happen to someone who just crossed $1 million in investments and suddenly feels wealthy. Now, remember, the issue isn't spending money. You've earned the right to enjoy some of what you've built. The issue is unconscious spending, the kind that sneaks in gradually, that you never sit down and deliberately choose. A $2,000 monthly increase in expenses might not feel like a big deal at this level, but over a year, that's $24,000. Over a decade, that's $240,000 that could have compounded into something significantly larger. The math on lifestyle creep is brutal in slow motion. The people who protect their $1 million and grow it into $3 million or $5 million are the ones who make conscious, intentional choices about what they spend on. Not because they're cheap, but because they understand that every dollar spent is a dollar not compounding. They distinguish between spending that genuinely enriches their life and spending that's just keeping up with a version of wealth they feel they're supposed to perform. The second million arrives faster than you think. Here's something that will genuinely surprise you if you haven't thought about it before. The second million is dramatically easier to reach than the first. Not because you suddenly earn more, not because you discover some secret investment strategy, but purely because of the math. At $1 million invested with a 10% average annual return, your portfolio generates roughly $100,000 in a single year. That means you're already making meaningful progress toward the next $300,000 or $400,000 gain just in year one without contributing anything extra. Add in even modest annual contributions, and the timeline to $2 million shrinks from decades to years. This is what investors mean when they say the first million is the hardest. Every dollar of your first $100,000 felt like a grind. You were fighting against small contribution amounts, limited compound growth, and the slow accumulation of capital. But at $1 million, the portfolio itself becomes your most productive employee. It works harder than you do. It doesn't take weekends off. It doesn't negotiate for a higher salary. It just compounds. The rule of 72 makes this visual. Divide 72 by your expected annual return, and you get roughly how many years it takes to double your money. At 10%, that's about 7.2 years to go from 1 million to 2 million. From 2 million to 4 million, another 7.2 years. The doubling periods stay roughly the same, but the dollar amounts get bigger and bigger every cycle. That's the engine running quietly in the background once you clear the first 7 figures. What changes in your behavior as a result? You start thinking in longer time frames. Short-term noise in the market matters less because you can see the bigger arc of what's happening. A volatile quarter stops being a crisis and starts being context. You develop patience, not because you've become more disciplined overnight, but because the math makes patience feel completely rational. The identity shift nobody warned you about. Let's talk about something that's a little harder to quantify, but probably the most underrated part of this whole conversation. When you hit $1 million invested, your identity quietly starts to shift. And that's both powerful and something worth watching carefully. For years, maybe your entire adult life, your financial identity has been built around building, saving, accumulating. Every sacrifice had a purpose. Every decision was filtered through the lens of, will this help me get there? That narrative gave you direction, motivation, and structure. It was your story. And then you get there, and the story suddenly doesn't have the same ending you imagined. Here's what actually tends to happen. Some people feel a strange kind of emptiness, not depression, but a quiet disorientation. The destination arrived, and the map they were following no longer tells them where to go next. The goal that organized your life for years is now behind you, and you haven't yet built a new organizing principle to replace it. Psychologists who study wealth transitions note this identity confusion is surprisingly common, even among people who built their wealth gradually over many years. The healthiest response? Reframe the milestone not as a destination, but as a platform. Instead of asking, what do I do now that I've made it? Ask, what do I want to build from here? That reframe changes the psychology completely. You go from feeling like you've lost your purpose to recognizing that you now have the resources and the freedom to pursue a purpose more intentionally than ever before. This is also the stage where a lot of people start thinking beyond themselves for the first time in a meaningful way. Charitable giving, helping family members, funding causes they care about. These things become more accessible and more appealing, not because they've become more generous overnight, but because the pressure of scarcity has eased enough that generosity feels possible. That shift from purely accumulating for yourself to thinking about what you do with what you have is one of the quieter but more profound changes that comes with reaching this level. What $1 million really means.
So let's bring this all together, because everything we've covered points to a single central truth that most people miss when they set the $1 million target in the first place.
$1 million invested is not a destination. It never was. It's the point where the math starts working harder than you do. It's the point where your options expand in ways that quietly reshape your decisions, your stress levels, and your sense of what's possible. It's the point where retirement moves from vague aspiration to concrete, plannable reality. It's the point where risk feels real. Lifestyle choices require real intentionality, and your identity has to evolve to keep up with your balance sheet. But here's the thing that matters most, and this is the most important takeaway of everything we've discussed. The person who reaches $1 million isn't dramatically different from the person who's at $800,000 or $600,000. The habits that got you there, the consistency, the patience, the willingness to delay gratification, the ability to hold through volatility, those don't suddenly become irrelevant when you cross the line. They become even more important. Because the biggest risk at $1 million isn't a market crash. It's not about investment. It's not inflation. The biggest risk is believing you've arrived somewhere that no longer requires the same discipline that built the portfolio in the first place. Lifestyle creep, complacency, and the subtle erosion of the habits that got you there, those are what actually derail people who reach this milestone. What if I told you that the $1 million mark is really just the universe asking you, now that the pressure is off a little, who are you actually going to be? That question, more than any market return or withdrawal rate, is what determines whether you stay at $1 million or build something truly extraordinary from it. The first million is the hardest. Everyone who's crossed it will tell you that. But it's also just the beginning of a completely different game. One where the rules are more interesting, the stakes are higher, and the potential, if you stay intentional, is genuinely extraordinary. You've built the machine. Now it's about what you build with it.